Uber's self-driving unit is losing $100 to $200 million a year. Is pouring money into this, continuing to pour money into this, the right call?
Yeah, so, I saw the intelligence report that Bloomberg came out with recently about ride sharing and the importance of autonomous as a path to building profits for the company. And having been an investor for a number of years now, we fundamentally believe that there is a profitable path for the business with a human driver model only. And the company, they just reported their Q2 earnings. They did $12 billion of ride volume. That number is growing, almost 50% year over year on a pro forma basis. And what that tells me is that the company right now is solving for growth. And so, yes, they're burning a little bit of cash, but just like we've seen with Amazon or Netflix, that trade-off between growth and profitability is the decision and judgment call that management's making. We think it's the right thing to do. So from a human driver and investment standpoint, we think there's a viable business. Autonomous is a long ball opportunity, and the company is definitely going to continue to invest. But we're very confident about the human driver model being sustainable and viable standalone.
So there's no question that self-driving technology will at some point be, a huge driver for ride-sharing companies like Uber and Lyft. But the question is when. Bill Gurley, former Uber board member, famously, butt heads with Travis Kalanick about when this would happen. I mean, Gurley believes that self-driving cars really aren't going to be realistic for 2, maybe 3 decades. I mean, what do you think?
Yeah, I'm more in the Gurley camp on this. So, from the work that we've done, the conversations we've had, and the sheer number of technology, regulatory, and then the just challenges of mass producing cars at scale, we're a long ways away, at least a decade, from any sort of material impact from mobility, these autonomous cars taking a chunk out of the overall bookings volume of Uber's business. They've got 2 million drivers on the road today, in the United States. And that's a lot of cars to have to build that to replace, those human drivers. So I think it's going to take a long time, and I'm much more in the Gurley camp than, sort of the more near-term technocrat view of, we're going to have self-driving cars, in 2020.
Okay, so, you guys have just raised a new fund. Where do you see putting this money to work? What's the next big opportunity if ride sharing was the last one?
Yeah, so, thank you for mentioning our new fund. The thing we're most proud about is the fact that we raised that capital from, more than 250 successful entrepreneurs and executives. And so we're always looking for businesses that we can leverage those executives and entrepreneurs to help our portfolio companies be more successful. I think the area, and it's actually more of a geographic theme than anything else, the area we're spending a lot of time right now is in China. We recently made an investment in Tencent Music. We're investors in Alibaba and Financial. And our view is that the China consumer opportunity, that growth vector is going to be extraordinary over the next 10 years, and an investment theme that's going to dominate the headlines over the next decade. So we're spending a lot of time in China as an area of focus. And then in terms of business models, we continue to focus on cloud, SaaS technologies. We've had a lot of success in security, lots of money going into that category, but even vertical market opportunities like education, energy, healthcare, IT, we're spending a lot of time looking at those categories too.
That said, we're seeing a ton of capital out there, whether it's SoftBank with their $100 billion fund, or Toyota, a non-traditional investor that we've just confirmed is investing $500 million in Uber. Has all of this extra money out there made your job harder? And is there really a place for you to deploy all of it?
Yeah, it's a really good question. I do think what we're seeing is a structural shift between companies going public much later than they historically have. And so what would happen is that a lot of value and market cap would accrue to public markets investors versus private markets investors. And so in the case of Amazon, had you invested in Amazon at the IPO, you could have made 100 times your money. But from the Facebook IPO price to where they are today, it's more like 5 times your money. So we're seeing this trend of businesses going public later. That means that more value is going to accrue to private markets investors. And so the pool of opportunity and value creation to capture is larger today than it historically has been. I'm not denying that there's a lot of money floating around out there. $100 billion from SoftBank is a ton of money.
Okay.
But the private value creation story is definitely on an incline. So we're going to participate in that.